Building a $100,000 investment portfolio from scratch may sound ambitious, but with the right strategy and discipline, it's absolutely achievable, especially in 2025. Today, we'll explore practical steps to grow your wealth, including smart asset allocation, leveraging new market opportunities, and managing risk effectively. Whether you're a beginner or looking to refine your approach, this guide will help you lay a solid foundation for financial success in the year ahead. Let's dive in and start building your $100,000 portfolio, one smart move at a time. Today we will talk about how to build a $100,000 investment portfolio from scratch in 2025. So before we start, make sure to hit the like button and subscribe to my channel. 1. Understanding the goal and setting a plan. Building a $100,000 investment portfolio from scratch in 2025 begins with a clear understanding of your financial goals and a realistic plan. First, assess your current financial situation, including income, expenses, debts, and emergency savings. Before investing, establish an emergency fund covering 3 to 6 months of living expenses to protect against unexpected events. Then, define the timeline for reaching $100,000, whether you want it in 5 years, 10 years, or longer, which determines your investment strategy and risk tolerance. Setting smart, specific, measurable, achievable, relevant, time-bound goals is crucial. Next, consider how much you can contribute monthly or annually towards your portfolio. Consistency and discipline in investing are just as important as the amount. The earlier you start and the more disciplined you are, the better compound interest will work in your favor. Finally, familiarize yourself with basic investment concepts like risk, diversification, and asset allocation to build a strong foundation for your portfolio. 2. Building a strong financial foundation. Before investing, ensuring a strong financial foundation is critical. This involves paying down high-interest debts such as credit cards, personal loans, or payday loans, which often carry rates exceeding investment returns. Carrying debt while investing can be counterproductive. Additionally, optimize your budget to increase your savings rate by tracking expenses and cutting unnecessary spending. Automate your savings to make regular contributions effortless and less prone to emotional decisions. If your employer offers a 401k plan or similar retirement accounts with matching contributions, take full advantage. This is free money that significantly boosts your portfolio growth. Open a tax-advantaged account like an IRA or Roth IRA to shelter your investments from taxes, which can erode long-term returns. Lastly, educate yourself about different types of accounts and their tax implications to select the best vehicle that aligns with your investment goals and timeline. 3. Choosing the right investment vehicles in 2025. In 2025, investors have a broad spectrum of investment vehicles at their disposal. Stocks remain the backbone for long-term growth, providing ownership in companies and dividends. Exchange-traded funds, ETFs, and mutual funds offer instant diversification across many stocks or bonds, lowering risk compared to picking individual stocks. Bonds provide fixed income and stability, balancing riskier equities. Real estate investment trusts, REITs, allow investment in real estate markets without buying property, generating steady income streams. For more aggressive growth, consider emerging sectors such as green energy, artificial intelligence, or biotechnology ETFs, which align with future trends. Diversify internationally to capitalize on global growth while reducing country-specific risks. Cryptocurrencies continue to be volatile, but have gained wider acceptance. Allocating a small percentage to crypto could enhance returns but requires caution. Lastly, robo-advisors can help automate and optimize your portfolio, especially for beginners who want professional management with low fees. 4. Asset allocation and diversification strategy. Asset allocation is the process of spreading your investments across different asset classes to balance risk and reward. The appropriate allocation depends on your risk tolerance, investment horizon, and financial goals. A common rule of thumb is to subtract your age from 100 to determine the percentage of stocks you should hold, e.g. If you are 30, consider 70% stocks and 30% bonds. In 2025, consider blending traditional asset classes with alternative investments like commodities or cryptocurrencies for additional diversification. Within stocks, diversify across sectors such as technology, healthcare, consumer goods, and finance to protect against sector-specific downturns. Geographic diversification reduces the risk from any one economy faltering. Rebalance your portfolio annually to maintain your target allocation and capitalize on market fluctuations. Diversification doesn't eliminate risk but can reduce volatility and improve long-term returns, which is essential when building a sizable portfolio like $100,000. 5. The power of dollar-cost averaging and consistency. One of the most effective strategies to build your $100,000 portfolio is dollar-cost averaging (DCA). This approach involves investing a fixed amount regularly, regardless of market conditions, which reduces the risk of buying at market peaks. Over time, DTA smooths out purchase prices and reduces emotional decision-making, helping you stay disciplined even during market volatility. Regular contributions harness the power of compound interest, where your investment gains generate their own gains, accelerating portfolio growth exponentially. Use automatic transfers to your investment accounts to ensure consistency. The key is to focus on the long term and avoid market timing attempts, which are notoriously difficult even for professional investors. Patience and persistence pay off, especially when starting with smaller amounts that grow steadily. The habit of consistent investing in diversified assets will build momentum, helping you reach the $100,000 milestone more predictably. 6. Leveraging tax advantages and retirement accounts. In 2025, optimizing tax efficiency is vital to accelerate portfolio growth. Tax-advantaged accounts like 400 and Onyx, IRAs and Roth IRAs shield investments from taxes, either on contributions or withdrawals, depending on the account type. Contributing the maximum allowable amounts to these accounts annually should be a priority, since taxes can significantly reduce net returns over decades. Health savings accounts, HSAs, offer triple tax benefits and can be used as supplemental retirement vehicles if you qualify. Consider tax loss harvesting in taxable accounts, selling investments at a loss to offset gains and reduce taxable income. Municipal bonds provide tax-free interest income, suitable for high-income earners. Understanding capital gains taxes and holding investments for more than a year to qualify for lower long-term rates can enhance after-tax returns. Consult a tax professional or financial advisor to tailor strategies to your situation. 7. Monitoring, reviewing, and adjusting your portfolio. Building a $100,000 portfolio isn't a set-it-and-forget-it endeavor. Regular monitoring and reviewing your investments ensure your portfolio stays aligned with your goals and market conditions. Set quarterly or semi-annual check-ins to track performance, rebalancing when allocations drift significantly from your target. Use online tools or investment apps to analyze your holdings, fees, and returns. Stay informed about market trends, economic indicators, and geopolitical events that may impact your investments. Avoid reacting impulsively to short-term market volatility. Focus instead on long-term fundamentals. If your financial situation or goals change, adjust your contributions or asset allocation accordingly. Periodic reviews also help identify underperforming assets or costly funds that should be replaced. Keeping a disciplined, informed approach mitigates risk and maximizes growth, crucial for successfully reaching your $100,000 target. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.